Hello and welcome. I'm Tushar Chande. Are you new to technical analysis and do you want to get better? You found the right video. You see all those indicators in the blue box below? I've invented every single one of them and a whole lot more. Today I'm going to talk about Introduction to Moving Averages. So if you want to learn more about moving averages and how they work and how they can be used, you've come to the right place. So let's get started. Please take a moment to review my disclaimer and remember that past performance is not necessarily indicative of future results. So let's start our discussion by looking at simple moving averages. On this chart, using daily data, each bar represents 1 day of price action and the red line is a moving average. That's because the calculation window moves. So if you look at this window of 5 bars, we simply average the daily close and plot it at the right hand edge of the box. Then the entire box moves forward 1 day. The oldest data drops out, the new data comes in. Inside the blue box, we again calculate the arithmetic average and plot it at the right hand edge of the box. And the process continues. So that's a simple moving average because it just uses an arithmetic average of the data. So these are the parameters that describe a simple moving average. First, it has a fixed period or length, say 10 days. Each data gets a uniform or equal weight equal to 1 divided by L, where L is the length of the average. So for a 10-day average, the weight is 1 divided by 10, or each data point gets 10%. And the sum of the weights is 1. So now we can use this to look at other averages. So this is what the moving average looks like algorithmically. The weight is 1 divided by L, and we'll denote that with the italic W, and L is the length of the moving average. And the formula for the new value of the moving average is simply the weighted amount of the new data that come in minus the weighted amount of the oldest data that drop out plus the previous value of the moving average. So as the window of fixed length moves, the oldest data drops out and the newest data come in. So for this reason, this moving average, the simple moving average, has no memory because the oldest data are physically deleted from the calculation. And that's a very important feature of SMA. So this chart shows you that we can construct all different types of moving averages by changing the weighting scheme. So the horizontal axis is the 10 data points for a nominally 10 period moving average. The vertical axis is the weight assigned to each data point. The blue line going across at point 1 shows that each of the 10 data points has equal weight. So this is a simple moving average weighting scheme. The orange line shows a triangular moving average, which gives more weight to points in the middle and lesser weight to points at the ends. And the gray line is sort of an exponential weighting scheme that gives much greater weight to more recent data and significantly less weight to older data. You can imagine that you could come up with all sorts of different weighting schemes to create different types of moving averages. So these are the names of some common types of moving averages. We've already seen what a simple moving average is. You can have something called an exponential moving average, a weighted moving average, a triangular moving average, an adaptive moving average, and so on. So let me show you the algorithmic similarity between the simple moving average and the exponential moving average. So this is the algorithm for the simple moving average, and we simply replace the oldest value with the oldest value of the moving average rather than deleting the oldest value that just fell outside the moving window. So the algorithm now looks like average minus W times the average, or that is the previous value of the average. And so we can rewrite that the new value of the exponential moving average is some fraction of the new price plus 1 minus that fraction of the old value, the moving average itself. What does this mean? This means that this exponential moving average has memory because the oldest data point that went outside the window is not deleted. We've simply replaced that with a moving average. So this average still has some memory of some fraction of this value that in theory has dropped out of the moving window. So this exponential moving average has memory, and the weight is usually calculated as 2 divided by 1 plus L, whereas for the SMA it's usually just 1 divided by L. But the sum of the weights is still 1. So schematically, what I want you to understand is that we have sort of transitioned, found a way to hop, skip, and jump from the algorithm for the simple average to the algorithm for the exponential moving average. So in this chart, we compare the 9-day exponential moving average to the 5-day simple moving average because both of them give the same weight to the newest data equal to 0.2. So you see that the red line, which is the 5-day SMA, follows the data more closely than the black line, which is a 9-day EMA, because the EMA has memory from previous data points, so it lags or responds less slowly to the new data than the 5-day EMA. So that just gives you a sense that even though the weight for the newest data is the same in both the averages, because of how the older data are treated, the averages behave quite differently. So this just reminds you that we can create moving averages that behave in all sorts of different ways simply by playing games with how we weight the data included in the calculation of the moving average. So this chart compares a simple moving average to an adaptive moving average. The red line is what I call the Chande Ulraflex Moving Average because it automatically adapts to market data using volatility on two dimensions. Its length, which can vary from between 5 and 30 days, and its offset, which can vary from 0 to 5 days. So you see that I can get completely different behavior by changing the algorithm, even though I'm basically using the SMA approach to calculate both averages. So the blue line here responds much more slowly than the red line, which is the Ultraflex average, during this sharp sell-off in March 2020. So this is just an example of how you can be very creative in designing moving averages. So let me show you how you can use moving averages. Usually people use two moving averages, so you can use as many as you want. When you're using two moving averages, you typically use one with a shorter length and one with a longer length, and you can look for buy and sell signals with a crossover. You can look for buying against the longer or the shorter average during pullbacks or rebounds, or you can use them as trailing stops. So let me show you some examples. So this is a chart of the SPY ETF, which follows the S&P 500 index. The two averages are the most popular lengths of 50-day SMA and 200-day SMA. So clearly the first application is what is the trend? If the 50-day moving average is above the 200-day moving average, the trend is higher. If it's below, then the trend is lower. So that's one application. The other application is you can buy retracements to the moving average, like you could buy every time the prices came down here to the moving average, or you can sell against the moving average. So every time the prices rebound near the 50-day moving average, you could sell them, or you could trade the crossovers. For example, this crossover here would be a sell signal, even though prices have already made a big move, and this crossover here would be a buy signal. Similarly, this crossover here would be a sell signal or an exit. So these are the common ways you can use a simple moving average or a combination of moving averages. This is another indicator using a difference of two averages. So in the lower panel we have prices. The red line is the 12-day exponential moving average. The blue line is the 26-day exponential average. The upper panel plots the difference between the two averages. When there's a trend, the difference is large. When there's no trend, the difference is small. So this indicator is called the moving average convergence divergence. So for example, here when the prices were falling, the two moving averages are diverging. Initially the divergence is low, then the divergence is high. So you see that this line moves away from zero, giving you a signal that it's trending. And then when the two lines converge, it turns positive and the difference is small. So this is an example of averages converging and diverging. They diverge during trends and converge when there's a consolidation. And so the indicator is called moving average convergence divergence. So this chart is an example of using simple moving average crossovers to generate trading signals. The red line is a 12-day SMA, the black line is a 50-day SMA, and the crossovers are in blue circles. So for example, here we got a nice crossover which led to a long trend and then a cross under which you could have exited or sold. But here you see that we got a succession of crossovers. So that's the problem with moving average systems. When you have a tight consolidation, you have multiple crossovers. that generates multiple long short signals, and not all of them are profitable. So tight consolidations lead to losses when you're using moving average crossover systems. So this chart of Apple is an example of using the default MACD system included with Metastock. We talked about the MACD signal a few slides ago. It's the difference between two averages. So for example, in this swing move, the MACD system generated a buy signal not too far from the low and a sell signal not too far from the high. But for example, here it went short too early, and during a tight consolidation, it generated multiple entry and exit signals. So again, the MACD is also showing the same underlying trend that when you have swing moves, the averages work well. When you have tight consolidations, they don't. So this is an example of using a adaptive moving average as a trailing stop. We have the price chart of Tesla, and the blue dots are the VIDYA or variable index dynamic average adaptive moving average. And you can see that it moved very rapidly and accelerated as prices themselves accelerated. So the potential exit was only 2 days after the absolute high of the move. So that would be a very attractive exit strategy. I hope you've enjoyed my discussion on moving averages. I have a package for Metastock called Tushar Chande's Complete Toolkit, which is very powerful, has systems, has a variable index moving average, and has other trailing stops called a volatility stop and a delay channel stop that you can use for your trading. You can find the package at metastock.com/Chande. You can find the Ultraflex Moving Average and a whole bunch of other really nice and powerful indicators in my package for NinjaTrader, and you can get it at chandeindicators.com. That brings us to the end of the slide deck. I hope you will check out my blog at chandeindicators.substack.com. Thank you very much for listening to the end, and have a great day.